Hello and welcome. I'm Jonathan Beale, and this is the ASB Investment Podcast, a show that keeps you up to date on the market and helps you make smart choices with your investments. What do the different COVID-19 alert levels mean for the economy and investments? Chris Tennent-Brown gives us an update in today's episode. We also chat about how the markets are looking compared to earlier in the year and what to look out for over the coming weeks. These are entirely our own views. It's not investment advice, but we know plenty of experts at ASB. They'll be happy to chat if you need. Morning, Chris. Good to talk to you again on virtual. I can't see you. I did have a bit of a quick. We did have a bit of a quick video chat before we started, but hey, lovely to talk to you again. How are things with you under level 3? Are you doing anything different to what you were doing in level 4?
It feels pretty similar to me. The big difference in level 3 is I've got a builder in the backyard doing some things that I've had planned for a while that had to get put on hold with the lockdown. But now that we're at level 3, he's working in the backyard, which is really satisfying. And the other change for me, which has got nothing to do with the levels, is my partner's a flight attendant, and she's one of the few that's flying at the moment. So I miss her, but given the amount of mess that the builder's been making, it's probably quite good that she's not here, and hopefully I can get everything sorted out before she gets back.
Well, I never thought we'd be pleased to hear the sound of buzzsaws, and we're looking forward to it. But yeah, I'm not really doing anything different. One thing I have noticed that is different though, and I don't normally spend this amount of time at home, is our garden just seems to have a multitude of birds. Like every time I'm on a call, people are sort of asking me whether I keep birds and stuff, which I don't. But our garden seems to have had all these birds come to it with less people around and less noise. They seem to have congregated here, which is quite lovely, actually. In like little twerpy and singing in the mornings, it's great. But very different.
I've noticed it too. It's fantastic here. We've got some native trees in the backyard, and the tuis have just been going absolutely nuts. And I've wondered whether it's the lack of traffic that I'm aware of them, or the lack of traffic's meant that they're happy to hang around my place. So either way, it's been nice, and I hope it continues.
Yeah, definitely. And I think it was, we are now in level 3. I think it was Judith Collins who talked about level 3 being basically level 4 with KFC being open, which I suppose is quite a good definition. But I suppose more importantly, like level 3, what does it actually mean for the economy here?
The big thing it means is a stack of people have gone back to work, and the construction sector is a really big one. You know, there's hundreds of thousands of people employed in that sector, and not all of them are able to get back to work, but there's an awful lot of people that can start getting back to work. Clearly a few more shops open, which I think is a really good step. Two things. One is it's a chance for us to ease into it and monitor how it goes in terms of the COVID-19 spreading. But the quicker we can get back to normal from a business perspective, the less economic damage this is going to do. So hopefully we can just keep going onto level 2, and more people can get back into the labour market and start working, and life can get back to normal. So hopefully this is a sign that we're into the transition stage to the new world we get, rather than the crisis stage that we were in back in late March, early April.
Yeah, and I was quite surprised actually from 4 to 3, the amount of people that level 3 enables to go back to work. See, there's been numbers between sort of 400 and 500,000 people. So it does show what difference moving down to 3 will make to the economy.
Absolutely. You've got teachers heading back to work. The construction sector is a big one, and parts of the service sector that are back to normal. The sector that's not back to normal is relates to the tourism sector, planes, airports, hotels. So there's a lot of people that are still no change from their employment perspective. So there's still a long way to go, but it's good to see people getting back into it. Another little change I've noticed is just how quickly the traffic has picked back up again over the lead into the change and then now. So that's a bit of a downer. The things that we grumble about, like congestion, are probably not too far away.
Yeah, exactly. And I suppose like share markets have continued to recover and are posting some pretty big gains on sometimes on a daily basis. But I suppose they're factoring in that it's going to be a successful transition through the levels and back to whatever normal is. Is that what they're hoping for or factored in?
I think so. I think there's three key drivers to the share markets. Initially, we saw the big drop, in part was driven by the stress in financial markets, and the central bank actions all helped with relieving some of that stress by cutting interest rates and increasing liquidity in markets. Then the next kick up was the fiscal response, the support that governments are providing to business. And over the last week or two, it's been this thought that economies are going to start to reopen. So we're in the real test stage of that, I think, over the coming weeks, and that'll be one of the key themes in May, is just how well we go. And as the government here has done a reasonably good job, I think, of communicating, if we see a big number of outbreaks, well, unfortunately, it means we're not progressing to more people coming back into the workforce. So these daily cases and the developments of new clusters, or hopefully the lack of developments of new clusters, will be key to us all getting on with our lives. But it's also a real key driver for share markets at the moment, that are looking through what's going to be a terrible second quarter for the economy and a terrible second quarter for businesses, and starting to look through to the other side. So I think this transition bit that we're in now is incredibly important for markets. Amazing recovery we've seen over April.
And do you want to talk a little bit about the recovery and actually what we've seen in markets, and where we were sort of back in beginning of March to where we are now?
Yeah, it's at worst, we saw markets were down about 30 to 35% from the peaks that they'd set in February. It seems like a long time ago, but it was only a couple of months ago that we had those record highs, and we were really looking at this as something that was isolated to China. And as it spread around the world, markets got more and more worried, and we were down that sort of 30% or more off the peaks. Over the last month, markets have recovered more than half of that dip. So now if we look at markets, they're 10 to 15% off the peaks. So well over halfway back. So that's really encouraging. I don't think we're out of the woods yet, but if we now start to look at market performance on year ago levels, it's looking a lot better than what it was. And so that's really encouraging. Investors will see that, and things like their KiwiSaver balance will have recovered from the lows in late March and be looking a little bit better. But if they check their balances out through March, they're probably still not recovered all of the lost ground yet, but hopefully they're seeing signs that things have improved quite a bit.
Yeah, it does sort of go back to that sort of stuff we've talked about, and you've talked about a lot before, about it sort of trying not to time the market, and time in the market is the key thing. And you can see, the majority of people, I think it was Aidan who was talking about it a couple of podcasts ago, about the number of people who actually have done nothing with their KiwiSaver, have kept on track, have just sort of ridden out most of the falls and recovered most, and actually maybe have benefited certainly as well from buying some maybe cheaper units when markets were down. Taking that long-term view certainly does pay off.
Yeah, it's hard at the time to go just stay put, and when things are so volatile, but people that did do that are rewarded now. And just like every other big dip I've seen, one of the things that's happened this time around is the clouds haven't all cleared, yet you've had over half of the recovery come in a very short space of time. And so people are now asking, is now the time to invest, with that sort of timing aspect in mind. But realistically, the time to invest was when we had absolute panic, when everyone wanted to sell. If you thought that you could time that sort of thing, but what's the saying? Invest when there's blood on the streets. And we weren't getting calls about wanting to invest in around 25 March when markets were going so badly. And now we do get a bit. So we just come back to that thing, stick to your long run plans. You just can't time these periods of market turmoil, that's for sure. I've had a lot of questions about, should I stop my regular savings plans when markets are volatile like this? And hopefully people have managed to keep going through this period. They would have got a couple of months where their dollars that they're putting into their investments went a little bit further when markets were dipping. And it seems counterintuitive to some people that you'd want to keep a savings plan going when markets are so volatile, but it's absolutely what you want to be doing if you can.
Yeah, there's definitely going to be two types of customers. There's going to be the ones, aren't there, that can't afford to continue with regular contributions to their KiwiSaver or the investment because of circumstances around their job and their income. And then there's the group of people who maybe sort of go, well, I'll probably stop because of the volatility. And it's those sort of customers who should be going, actually, no, volatility is good, and you want some volatility in your investment over the period, because actually there's times where you're buying the units in those investments which are cheaper. I suppose that the analogy is it's a bit like going to a shop when stuff's on sale. You're getting the goods for a cheaper price, which is an awesome thing to have. And it's that sort of, as you say, it's very counterintuitive, isn't it? But it's actually a positive for people's long-term imbalances that they'll see.
The other thing which is going on in the market now, to your other point, is people are rightly still quite concerned about their income over the coming months. There's still a long way to go, and in terms of the climbing out of this hole that the world's in, so we will see the labour market weaken considerably over the next quarter. So that's still going to be in people's minds as well. But that's more a question about budgeting rather than the right thing to do with making the most out of an investment.
It's also the question I'm getting is around maybe I'll invest where markets settle. I'm not sure markets ever settle, and actually holding off is probably not the right thing. I suppose you go back to sort of actually, why are you investing? What are you trying to achieve with the investment? And if your time frame is a medium to long term time frame, then yes, investing is probably the right thing to do. But I think what you're saying, probably even in the short term, we're going to continue to see some volatility with sort of maybe the economy not reacting how we thought, potential movements around COVID, and also I suppose it's reporting season. With companies talking about how it's affected them. I think that will probably weigh on the market as well, won't it?
Yeah, it will. We're going through that at the moment, and in the States, expectations are that companies take a reasonable hit in their first quarter earnings, but it's the second quarter that's going to be the bad one, as we were chatting about before. And the first couple of months of the quarter, the economy was trucking along same as usual in the States and here, and so companies got 6 weeks, 8 weeks of normal activity, and then March things started to really change. So there's the news flow at an economic level and at a company specific level is going to get worse over the coming months. Now, share markets will look forward to the coming years, but there's still going to be some tough data to digest. And on the ground level, companies are going to be dealing with really tough cash flow situations. So we're going to see more companies needing to come to the market, like we've done over the past month or so with Auckland International Airport and Kathmandu, and raise more capital. So there'll be more of that going on over the coming months for sure. So still plenty to digest. But to your point, there's not going to be a clear moment where markets are perfectly settled and it all looks great. There's going to be more challenges.
And then we talked about this. So it was a number of weeks ago, but negative interest rates seem to be back in the headlines. What's driving that sort of talk again?
Yeah, well, this is one of those things that's interesting now that's back as a worry for customers. And I think this happens when the Reserve Bank's done so much, like they've cut the cash rate to 0.25%, they're now doing quantitative easing. The logical question people ask is, well, what if they need to do more? What would they do next? So the negative interest rates come back on the discussion list. And one of the other banks came out and have forecast that that'll be the Reserve Bank's next step, and that's generated a little bit more coverage on it. But I think there's a couple of things that are really important to think about this. One is the people are talking about a negative official cash rate, which really impacts the rate that banks would be dealing with. But that's different from negative term deposit rates. And to be clear, we don't think that the Reserve Bank will move to a negative cash rate. They could. But we certainly don't think term deposit rates will go negative. But where we'd prefer to have the conversation with customers is on the fact that we don't think term deposit rates are going to go negative, but they are going to stay very low for a long time. And when we look at other countries like the States, like Australia, that have got cash rates to these levels, they've never gone negative with them, and they're not expecting to, but their term deposit rates have kept on grinding lower. So I think it's a real important thing for people when they're in cash and term deposits is just to be aware of that fact. The returns, we expect them to be very, very low, but we're not forecasting that they're going to have to pay to put their money in the bank, because I think most people would decide that they'd prefer to buy a safe than do that. That's not on our forecast, but these sort of 1 to 2% term deposits, I think, will be around for quite a while, which is really tough for term deposit investors, and I think they'll be down those sorts of levels for several years.
And then that I suppose opens up the door around maybe people looking elsewhere for sort of their income needs, which we saw sort of, I suppose, before COVID, which was one of the reasons that was driving the New Zealand and Australian share market so much. People's hunger for income and yield and buying quality stocks that pay good dividends. And I suppose, but you know that might sort of be tempered a little bit by people's experience through COVID-19, I suppose.
Yeah, no one ever likes volatility like we've gone through, but ultimately the answer to needing to have a higher return than those low-term deposits for people that have got the long-term approach is they will get the higher returns out of dividend yields from companies and a diversified range of investments. It's tough and understandable that people have got some reluctance to do that sort of thing right now when we've had a period of volatility. But that's where the returns will come from, and we're lucky in New Zealand that we still do have companies that are paying out decent dividend streams. And some of those companies, the airlines, for example, their income streams are going to be really challenged. But others, and I'm thinking of the utilities that we've got here, the power generators and suppliers are good examples. We'll still be able to pay out good dividends over the years ahead. So at least we live in a country where we've got access to other types of investments that can generate good returns. The other thing that's a little bit uncertain at the moment is property, and that's all to do with the shutdown. There's big question marks over businesses' ability to pay rent and what should be done about that issue. That's an area of the government's response yet that people are still saying, hey, what do we do in this particular space? And as a consequence, we've seen a lot of uncertainty and some weak losses, not weak returns, but losses in the listed property space, which has been a hard hit sector over recent weeks. But still, that focus for needing income will get people back to those assets over the next 10, 15 years, that's for sure.
And the going back to the official cash rate quickly, just that using that instrument, but I suppose with government investment and supporting businesses and sort of the amount of money they're pumping into the economy. I suppose the way the Reserve Bank think about it is they're using two areas to help rather than having to just keep reducing the official cash rate and go negative. I suppose the two complement each other, don't they? Oh,
absolutely. And I think the Reserve Bank's done a really good job over the last couple of years before we even got into this situation we're in now, where they really looked at the government and said monetary policy and fiscal policy need to work together. And lower and lower interest rates can't do everything. And I think we've seen a really good interplay between the two over the past month or so. The government's clearly going to need to issue a lot more debt. They want to issue that debt as lower cost as possible. And the Reserve Banks said, we're prepared to be in that bond market buying government bonds to keep long-term interest rates low. And we've seen that big change in government bond yields since they've done that. They've really come back down towards that 1% level from being quite a bit higher when people were really worried about how we're going to pay for all of this and how stressed out a market's going to be if we have this big recession. So those two things, the government and the Reserve Bank, have worked independently from each other, but in very, very good coordination. I think it's a real positive thing. In turn, that's helped the equity market because people that are investing in companies are thinking that the overall framework's the right one.
And I suppose, like, moving on to sort of maybe things to watch. And when I say watch, I'm not really thinking about stuff on Netflix, like Tiger King or something like that. But like, what are sort of things that you're watching, or we should be looking at over the coming weeks?
I think the thing that we should all get encouraged by is the developments in the actual cases themselves. So it's been a tough couple of months of worry, a really tough month for people in lockdown. So to see it actually working, I think is important. From an investor perspective, I think that's important to the outlook because it will determine how quickly we can get back to a greater sense of normality, and that in turn is good news for the companies that we invest in. So that's what I watch. I look with satisfaction at how things are going in New Zealand and in Australia, and still with some concern when I look at places like New York and some of the other areas around the world that still have got a long way to go. That all ties in with our move to a level 2, hopefully in New Zealand over the next month. The other bits I think are really important is the actions of the government and the Reserve Bank. We think they'll do more. We don't think they're done and dusted yet. So the government's put a lot of money into the economy already, 20 odd billion, and we think that they'll end up spending twice that or more over the coming months and years to get the economy back on track. And in turn, we think the Reserve Bank will keep doing more. We're not picking a negative cash rate like some others are, but we are picking that they will step up the official level of government bonds they're buying. They committed to buying 30 billion over a 12-month period, which is a lot. There's only about 80 billion on issue, but we think that they'll lift that more towards the 50 billion mark. They're buying at that sort of pace now. So those are a couple of things in May that we'll hear about and will be a big focus for us in terms of our thoughts about the outlook. Is the budget and the Reserve Bank meeting that are now only a couple of weeks away.
And is it also something that you're maybe looking at? I think you were sort of briefly mentioned it, that sort of, if you think globally, the world is recovering from COVID-19 at different speeds, and is that something that potentially might impact New Zealand? So, if I use the example of New York still sort of in trouble, and the UK still seems to be behind the 8 ball, is that going to? Do you think that will have an effect or flow and effect to New Zealand?
Yeah, I think when we were chatting before about how markets were going, and part of it is this optimism that we're collectively coming out of the worst of the COVID-19 impact. I think any of these big economies, if you saw major signs that they're having a second wave, that could be really negative for markets and cause another dip again. We've been looking closely at the data out of China on that front, because they're really first into the situation and first out in terms of trying to get back to normal. But all of the economies around the world are going to be giving it a go over the next month or so to try and relax their restrictions. And how that goes, I think, will be incredibly important for people, but in turn the economies and companies and share markets. So that'll be a key one to watch globally, and it will impact the sentiment in markets over the coming weeks and months. Hopefully that all goes well. Fingers crossed at all sorts of levels that goes well.
Exactly. It has been fascinating. Watch how people, what they go back to. Hey, like, here there's been talk of, queues outside KFC, and like I ran around Devonport and just people queuing outside coffee shops. And like, if you go to Britain, everyone seems to want to go to a DIY shop. It's just amazing that the things that people have missed, and the first thing they go back to. Hey, it's been a fascinating it's example of human spirit.
It is interesting. Yeah, it's there's a whole lot of things that I think people have found really positive about this. The number of people walking around neighbourhoods and communicating and talking with each other has been really neat. It's a bit sad to see the trash cans overflowing with garbage the last couple of days because of people having big takeaway binges. So hopefully we take a few things with us from the month that we want to carry on as habits. But from a company perspective too, hopefully we start to see some return to normal for a lot of businesses as people can start to do a bit more I just hope they do a bit more than buying takeaways, and we start to see a broader range of shops and services start to open up, and that's what we'll be looking for over the next month. Probably at the worst end of the scale is the travel sector, because that seems to be a long way away that we'll resume global travel. But there's an awful lot of stuff that we'll be watching over the next month or two as we go through this transition phase, that's for sure.
And there's lots of awesome places around New Zealand to go and visit as well, isn't there? So I think there'll be this sort of return to supporting New Zealand as much as we possibly can, and buying New Zealand goods and supporting New Zealand companies, and getting out and about and seeing the beautiful country. I think there's worse places to be locked down around the world. I think we're, if you think about it, we're actually pretty fortunate, aren't we?
I think building a domestic travel list of where we all might travel next is probably a fun thing to do, to imagine what it might be when we get to lower levels of alert hopefully over the coming months.
Exactly. It might be something to add to my bubble list of things to do. It's, my latest thing is to wear clothes I haven't worn for years, just to try and broaden out my my wardrobe. So I'll certainly add the holiday list to that as well. Keeps me entertained. But hey, thanks, Chris. I might just draw it to a conclusion there. It's been wonderful to talk to you again, and your insights and your views. And it's been a pleasure to sort of go through COVID-19 up to level 4 and now to level 3 with you. And hopefully next time we talk, we'll be talking in level 2. So keep safe, and speak to you again soon.
Sounds good to me. Thanks for the chat.
Thanks for joining us today on the ASB Investment Podcast. If you have any thoughts on today's episode, or if there's anything you'd like us to discuss on future shows, please fire your suggestions through to podcasts@asb.co.nz.